Joining us now for some market strategy is Emily Sanders, CEO of Sanders Financial Management. And still with us, of course, is Roger Nightingale, strategist at Point York. First question here, I've got to ask. We're coming off some strong numbers with a record number actually beating the EPS. Stocks then surge as a result. But leave it to Nouriel Roubini to come in and talk about a possible double-dip recession. So what's your take on where we are in the state of the recovery? Are we going to continue to go up, or will we feel that bottom out again?
Good morning, Courtney. Unfortunately, I do agree with Nouriel Roubini. We see a W-shaped recovery, both in the equity markets and in the economy. And so we feel that we're on the top edge of the W right now. The market has run up unbelievably in 5 months. Really, stocks are overvalued in our opinion. And with the drivers of high unemployment still continuing to tamp consumption, the good news has been overinflated in our opinion, and we will see a 15% retracement in the Dow and S&P before things start leveling out and can truly recover.
And you mentioned employment right there. I've got to pick up on some of your points. I understand you think that while the unemployment number is quite high, it doesn't even tell the full story. There are so many more people on the sidelines trying to get in. Talk to us a little bit about what we're missing in those unemployment numbers.
Yes, there are discouraged workers and underemployed. So, for example, workers on severance pay or who are still not collecting their unemployment benefits, they're unemployed, but they're not counted. And then there are workers who are discouraged who've just stopped working. So if you really combine the underemployed and the discouraged workers, you're up to about a 15.5% true unemployment rate, which is not reflected in the numbers. The slight improvement to 9.4% national unemployment, we feel it will be going higher into the double digits in the ensuing months.
Roger, but your earlier let's bring you in here. Your earlier belief is though that things like high unemployment aren't going to have a meaningful impact on stock market performance.
No, I agree. Very, very meaningful on the economy.
Yes,
I absolutely agree. Unemployment is being somewhat understated in most economies of the world. Actually, less so, I would have thought, in the US than elsewhere. The potential for rising unemployment in Europe is just mind-blowing.
But it's not going to be a drag on stock performance.
Exactly. I don't think it's going to be, because I don't think we require for stock markets to go up. I don't think we require top-line sales improvement. We want bottom-line sales improvement. And so long as we can get wages being squeezed more than revenues being squeezed, I think we are going to find we have very nice stock market performance.
What do you think of that, Emily, that theory?
I respectfully disagree with Mr. Nightingale. As long as the consumer is being squeezed and is being forced into foreclosing on their homes, I mean, if you look at the number of homes, at least in the United States, that have negative equity and what are projected to have negative equity by 2011, we could be facing a situation if home prices drop another 14%, by 2011, about half of U.S. homes could be in negative equity. And when you combine that with 15.5% shadow unemployment and maybe higher, spending is going to be very, very muted. Businesses are going to be reluctant to invest until such time that unemployment number really starts to come down meaningfully. And in our estimation, housing won't be bottoming and unemployment won't really trough until about 2011.
You're wrong, Roger.
Well, no, I agree with everything you've just said, actually. I agree. I couldn't have said it better. I mean, all that's going to happen. Totally agree. We're going to get unemployment rising. You're going to get foreclosures. You're going to get all sorts of bad consumer sentiment. You're going to get companies not investing. I absolutely agree. GDP is going to be very disappointing. You go down, you go up a little bit for the middle part of the W, you're down again.
But you both disagree on the impact of that.
It's the impact it has on the stock market. It's the impact it has on profits. I think you can still get moderately satisfactory profits in this environment, and that in the context of very low interest rates, zero interest rates, very low bond yields, and extraordinarily easy money conditions, I think is a sufficient recipe for equities to rise.
Emily?
Without revenues rising, the less worse earnings is really not going to ultimately matter. Yes, true, businesses have squeezed costs out to the nth degree, better than I've seen them do in the last 20 years. But revenues are not rising. If you look at all the companies that have just reported the quarterly earnings, very few of them, maybe only a quarter, had increased revenues, and that really is a precursor to a true economic recovery.
So, Emily, this is Christine. Having said all that, what would you recommend clients do with their money then? Would you recommend they hold back and sit tight and wait for another drop and go back in, or just stay away from equities altogether?
We don't see a drop to the March 9th levels. So we do believe that having a good portfolio of dividend-paying stocks, we're really emphasizing the dividend paying now, good corporate bonds, tips are looking better because of the inflation threat, are a good place to go. We like preferred stocks. Some of them in the U.S. have yields, not bank preferred stocks, but industrial and so on preferred stocks can have a yield, 6-7%, and that's a good place to wait while the market, or I should say the economy, shows signs of life again. And, we do agree with Jean-Claude Trichet, who was a little more cautious in his comments than Bernanke was at Jackson Hole. We think he's being a little more realistic about how bumpy the recovery is going to be.
Thank you, Emily, CEO of Sanders Financial Management. We also want to thank you, Roger Nightingale. You're both going to stay with us. We can't wait to hear more from both of you, of course. But coming up here on Worldwide Exchange, some lucky Italian has just won almost 100. Let's get a look ahead to the U.S. trading day, and we'll also be bringing back in Emily Sanders, CEO of Sanders Financial Management. Emily, it's nice to have you here with us again. Thanks for sticking around. We still got a couple questions left. We know you've got a lot of opinions on all of this going forward. We're going to have this big Treasury auction on Tuesday, $109 billion. What's the appetite going to be like for the Chinese? Are they going to buy in? What's the momentum like going into that auction?
There is a symbiotic relationship between the U.S. and the Chinese, and clearly they are still buying our Treasury debt, but at a slower pace. The U.S. dollar has already declined about 12.5% this year. It's in a secular decline. And so from the Chinese perspective, we really can't be surprised that they're looking at hard assets in other countries, buying into companies, real estate, et cetera, natural resources all over the world. Slowly but surely, the U.S. is losing its place as the world's reserve currency. And the deficit, is ballooning now to only $1.58 trillion instead of the estimated $1.84 trillion. And the Government Accounting Office has said that, it'll probably be $9 trillion in another decade or so, which now the Obama administration is agreeing with those figures. So what do the Chinese really have to look forward to? They're tied to us inextricably, but over time, they are looking for other places to invest.
Emily, hi, this is Christine here. We've got durable goods, consumer confidence sentiment, revised Q2 GDP. What exactly is top of your watch list? What are you looking for?
Well, one of the things that we're looking for that the media is really downplaying at the moment is the swine flu season coming up, in the autumn in the northern hemisphere. And the World Health Organization predicts that a third of the world's population will contract swine flu. And even if it's not fatal and it keeps people out of work and out of school, for a week at a time, this will really slow economic activity. So right now it's off the radar. We're at the end of summer in the northern hemisphere. But, developed countries are pretty soon going to go into a cold and flu season, and that could be a wild card that isn't really being talked about very much.
Emily, if you suspect we're going to get a setback in the stock market, what happens to bonds? Are you going to reallocate some more money back into the bonds?
We're already doing so, Ross, and we still find value in corporate bonds. The high yields were great a few months ago. They're starting to get, fully priced now. But there really are, many ways to build a layer of, good yield in the portfolios, both with high dividend-paying stocks and with good corporate bonds. So we're really getting much more heavily into fixed income, even though by doing so, some of this recent rally, has been muted. When things start going down again, which we definitely predict they will, then our clients will be better protected in that scenario.
Well, thank you very much, Emily Sanders, for joining us. Emily Sanders, CEO of Sanders Financial Management. We're going to take a quick look at the U.S. futures here before we have to say goodbye for the morning, and it looks like we